Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome back. Taking Stock, episode number 25. Art Jarvis is sitting here with me, chomping at the bit, raring to go. But how are you on this fine Tuesday?
As always, fantastic. Happy to be here. Can't believe it's episode 25.
I know.
Time flies when you're having fun.
Apparently, we're having way too much fun.
Too much.
And we were talking offline for the people that are hearing this. We were talking, before we just began to record this, and we're saying, when will it be a year? So we're just coming right up on a year.
We're getting close. Yeah.
Every 2 weeks, episode 25 makes 50 weeks. So in 2 weeks, that's basically a year.
Should be. That's
By
right.
our math.
That's right.
Well, and you're the math guy, so.
Math is hard, but I think you're about right.
Math is hard. I hope you don't think so. You're kind of doing math, aren't you?
In my world, the English language is hard. So, but.
Well, you seem to speak it pretty well with us here on Taking Stock. So
the hillbilly comes out every once in a while, but that's all right.
Fair enough. I don't know what I sound like. Anyway, I hope it's like the ignorance in regarding investment might show through pretty strongly.
You're the educated half of this partnership here.
Yeah. Well, we won't talk about who went to what school.
Okay. Right. Exactly. Yeah, I forgot about that.
Yeah. Well, we could talk about here locally. Right? Because in Cincinnati, for some reason, everybody talks about their high school.
Right.
Where'd you go to high school? It's not like, where did you go to college? Where'd you go to high school? It's like, what? Only place in the country. Everybody tells me that. Only city in the country where they experience, where did you go to high school?
I'm a Sycamore aviator, and I'm proud of it.
Well, regardless of what they say today, I am an Anderson Redskin.
Yeah, true.
Not whatever they're calling themselves today. So I'm on the other side of the fence. Sorry if I made any enemies because somehow being called a Redskin is a bad thing. But when I was at Anderson, we were Redskins.
Right. I'm pretty sure we're going to stick with aviator.
Aviator's pretty cool.
That's right.
I like to fly.
Yep, it's good stuff.
So aviator's good.
Yeah.
Redskins was fine. It was to honor the heritage of the community. There was some basis for that back then.
I understand.
Talking money, taking stock of where we're at today with Art Jarvis right here on episode number 25. I guess we should get to that instead of what high schools we went to.
Yeah. I mean, some Cincinnatians they'd rather hear about the high school. But no, I mean, we came off. We've been having. I always use it. It was October 27th when we bottomed, right before the Fed Chairman Powell came out and said that they were done raising interest rates, right? And matter of fact, we'll probably get a couple rate increases in 2024, and then we've talked about that before, and that ballooned, and it's so that I think that's where today's discussion might end up going, to be honest with you, but. We had some really good months, but April of 2022 was not one of them. So,
well, let's see. If I'm technically the host, I'll steer this show wherever I want it to go.
That's true. Good point. Good point.
Do we really want to talk about what the rates are going to do? Well, let's take a minute and do that, just to get it out of the way, so we don't go there. Let's start there and get away from there.
Well, if you want to get it out of the way, here's the interesting thing. So it's as I've mentioned, this is a slow process.
Freighter.
Yeah, freighter making a great big wide turn out in the middle of the ocean, and we went from we're going to get a couple rate decreases this year to all of a sudden people think we're going to get 6 or 7 rate decreases, and now we're to the point. And then we got to the point, well, now we're kind of hoping for 1 or 2 rate decreases. I think, honestly, we've kind of gotten to the point, in my opinion, that I think unless there's a speed bump in the road in the near future, we're probably not going to see a rate decrease this year. And honestly, with the numbers that we have received and are starting to kind of form a little bit of a trend, in not the direction that we want them to go. And it's starting to present the possibility that we might actually see a rate increase in 2024. Now, I'm not talking about anything big, maybe a quarter point, a tweak here or something like that, but we've gotten some inflation numbers that each time they're slightly higher than the month before, and they're also higher than what the projections were. And that is also the case this morning. We got the producer price index, which is the wholesale prices, and they were looking for it to rise 0.3%, and it actually went up 0.5%. So
half of 1%.
Half of 1%. So that and for the producer price index, that's actually at an annualized basis is 2.2%, which is not terrible, but it's a lot higher than what they were expecting. So, and couple that with the the consumer price index, which is the retail numbers, that has gone from roughly 3.2 to we're about 3.8 now on the inflation. Again, not a huge number, but heading in the wrong direction.
Clearly.
Yeah, and we're still seeing wages. We were year over year wages were increasing like 5.5%. They're down to increasing 5%, but that's still a big number. And then
it's still increasing.
Still increasing and increasing at probably twice the rate that you really want it to be increasing. So. And we talked about this a couple episodes before. It's the Fed still wants to try and get to 2% inflation, and I think that's becoming a little bit of a pipe dream at the moment. That's and number one, it takes a very long time to get down to that level, and it's not going to happen this year. Let's be clear about that. So people's attitudes are changing, which. Last month, coupled with the fact that everything was going on in Israel and Iran and Ukraine and all that, we gave up a little bit last month, and I think we dropped, just call it around 4%, a little bit over 4% we lost in April. But, here we are on May 14th.
Correct.
And we've gotten all of it back in the last 2 weeks. So... we were heading our way to 5,300 on the S&P 500. We dropped down to just call it about 4,900 last month. Here we are again. We're at 5,250 or something.
I was going to say I thought at the close yesterday I thought I heard 52 something. So
we're banging on that door of 5,300 again. So ebbs and flows, but it's. A lot of the expectations that were being presented at the beginning of this year have definitely fallen to the wayside.
I don't want to be that journalist or so-called journalist, media person that's, like doom and gloom or I used the term when we were offline, which I won't use now, and you said, well, there you go, the journalist. I don't want to be that guy, and I don't want to be that media thing. But is it correct right now to say that what we've seen over the last, let's just say, over the last month, certainly through the month of April, is it fair to describe the market as, like market volatility?
Well, definitely, if you look at April, like you said, last month, the volatility was most certainly there.
Yeah. Well, so the question that comes from that, and I didn't want to describe it as a volatile marketplace over that last month, if that was not correct, and that's your expertise, even though I picked a word, But anyway, you said it well, so you can understand it and relate. But so market volatility through April. What was in you use all those numbers. So what are the numbers? What are the things that were happening, the trends throughout April that was creating that volatility from your analysis?
Yeah, there was a lot in April, actually. You start where, we were at 3.3 on a 3.3% growth on a yearly basis with gross domestic product. Well, that new number came out, and it was at 1.1. So still a positive number, which is good, but a lot less than what it was before, so somewhat of a slowdown for that year-over-year number. And then you have the inflation numbers coming out, which were stronger than expected, worse than expected. So that started to cause interest rates to move up. So we went from 4.25% interest rates up to 4 2/3 on the 10-year. So now you're messing with the interest rates. You got the inflation starting to show up again. That completely changes your attitude about whether we're going to get rate decreases this year. So you have those kinds of numbers come out. You have employment numbers that come out that were maybe slightly worse than expected. So all of a sudden there was a substantial dose of negativity. And then take all of that and throw in Israel and Iran, what was going on there. And we have talked about this multiple times. The markets do not like uncertainty, right?
Right.
So that was a full dose of uncertainty on top of a batch of worse than expected numbers and things like that. So yeah, that took us down pretty quickly. That one, actually the 1 week I was in Houston. I mean,
right.
We had 6 down days in a row, and
don't go to Houston ever again.
Well, I know. Well, usually, the joke around the office is the market goes up when I leave town, so that definitely bucked the trend. Usually I go out of town and the market goes up, and they tell me to just stay out of town, don't come back. But
go away and don't come back.
That's right. We'll call you if we need you. But
to be blunt,
that's right. We got this under control. Leave us alone. But yeah, so to answer your question, there was a full dose of, from an economic numbers standpoint, from a geopolitical standpoint, all those things, concocted a very negative environment. But apparently everything's, the markets seem to feel that things are getting much better because we've gained almost all of it back. We're maybe 0.5% away from the top, so we've gained most of it back.
Well, in your 35 plus years doing this, obviously knowing the numbers, following the numbers, using the numbers, and guiding people's investments with the numbers, have you seen, because I don't know, so I have to ask. People listening probably already know this answer, but I'm going to ask anyway, which is, have you seen like the ups and downs in the day as regularly? I think we're seeing regularly, like we started today, we're in the red, we're in, everything's down, and it's, now it's, at least flatlined or maybe a little bit up as we sit here and record this during the noon hour on the 14th. I mean, in those 35 plus years, has that been a common thing, or is this a unique situation?
It depends on, there are years that are more volatile than others.
But I mean, on a given day, every day is like, wow, we're down, we're up all day long.
Yeah, I mean, the worst case on a daily basis was back during the pandemic, because everybody in the world is trying to figure out what's going on in the world and what's going to happen tomorrow and things like that. It's kind of interesting if you look at even the last 2 days here, we've basically been flat, and we're basically, I sit here and I can watch the market. It's red, which means the market's down a little bit. Then it's green, which means it's red and green, but it's on a very tight range. I mean, I think that the S&P yesterday finished, if I remember correctly, down 0.02%.
It was minimal.
So what that says to me is, okay, the world didn't come to an end last month. All the stuff we were worried about, especially from a geopolitical standpoint, didn't come to fruition. So now everything got better. Now we pushed the market back up, but we're still getting some negative numbers, and there really isn't enough from an interest rate standpoint and from a earnings standpoint to really push the market much higher. I think, if I remember correctly, at the beginning of the year, I made a prediction for 5,300 on the S&P. It was either 53 or 5,400 on the S&P. We're almost there.
I'll call you on that at the end of the year.
Yeah. We'll see what happens.
Because you don't know how it's going to go up and go down. But
there you go.
In my mind, it was 54, but
okay, 54. I mean,
I don't have that right in front of me.
Yeah,
I was going to do a little more homework than I did do in terms of preparation for today, but I saw. So who's Jefferson? The Fed's Jefferson.
He's probably just a Fed governor. So you have the Federal Reserve.
Right.
You've got the chairman, who is Powell. And then you have several Fed governors. So like in Philadelphia and New York and
Sure.
Atlanta and things like that. Yeah.
Well, there was, I like I said, I was going to do a little more homework because I wanted to follow up with what I saw. Something from Jefferson on Monday, May the 13th, about what's going on with the inflation numbers. And I didn't get a chance to get back to him, so I threw that question out. Who's Jefferson?
You're not talking about Thomas Jefferson.
No, we're not talking about Thomas Jefferson. You know. I knew Thomas Jefferson, and you're no Thomas Jefferson.
That's right. Thank you very much.
Whatever the heck that was.
Exactly. That's probably a good thing.
Something like that, or Ben Franklin or somebody. I don't know.
So, the point is again, in no way, shape, or form I'm trying to paint like a dire picture here. We're in the process of trying to figure things out, right? That there's not really enough fuel to push us a whole lot higher, but at this moment in time, there's not enough drama or not enough negativity to really push us that much lower either. We're kind of in this phase. It's like, okay, we're just trying to figure things out. We're waiting for more information, and we need, in my opinion, we need a positive surprise is what we need, right? So,
forecast one. What would be the positive surprise that you'd be looking for? Where could we potentially see that come from?
I mean, the biggest surprise that could happen right now is the Fed actually cuts rates a quarter point. I mean, that would be a huge surprise, right? And
the question is, though, if they cut the 0.25%, and you said a big positive surprise, would that not, with inflation still rising a little bit, would a cut not be,
in my opinion, a bad idea?
Right, so that's not a positive.
That's why I said it would be a surprise, but it would be positive because of how the market would react to it, because the market in no way, shape, or form is expecting a rate cut anymore anytime soon.
Right.
If it did happen, well, then you're forcing rates down, let's say, a quarter point, right? So as opposed to what's going on right now is just kind of the jawboning and talking rates up a little bit, talking rates down a little bit. So.
Well, you and I tend to spend a good deal of time on, on some of these episodes talking about, what we're seeing out there. The reality, and here we are. It is May the 14th. We are headed into the summer, summer months, the summer vacation, and that's a time the economy is lifted by, that whatever you want to call that, spending, consumer spending during the summer months. There's a lot of that entertainment dollar.
That's correct.
For a variety of different things. We've talked about that. We've seen, hey, drive by, the restaurants have people. Okay. The stores are seeing business, at least to our eyes.
Sure.
And it came up in conversation over this past weekend. And somebody said that thing that I've said to you. The question is, the consumers are out there spending, but are they spending money they don't have?
Yeah, right.
There's the question again. And you and I have talked about this, so kind of, I don't want to beat the dead horse, but again, what do we know? How do we know if people are incurring debt, right, or if they're spending money that they have to spend?
Yeah. Well, I think the answer is, once again, yes. It's a combination. I think number one, that I think in general, pretty much the vast majority of all this money we pumped into the markets over the last 4 years, $6 or $7 trillion that we pumped into the market, we pretty much worked our way through that. So there could be some where, okay, we're starting to put money on credit cards and things like that. Right. But also, don't forget that we're still talking about 5 to 5.5% rate increases in wages too. So people are on average are seeing larger paychecks. So there's theoretically more money there, depending on how you look at inflation, right? I mean, you might have more money, but if you're paying 20% more for a hamburger,
Yeah, we keep talking about the hamburgers and the cheeseburgers.
That's right. Yeah, the cheeseburger analogy. But yeah.
How much was that hot dog Friday?
I got a hot dog and a water for $13.58.
Well, that isn't bad because then the hot dog was only $8 since they charge you $5 for the water.
Oh my goodness!
Anyway, that's a different story.
Yeah, it's always very interesting to me to get a 20-ounce water. It costs $5 for a water. It's worse at the Bengals game. Yeah. So anyway, yeah, it's there, and it's not, as we've talked. It's unless something really bad happens in the world, it's not going away. I mean, there are times with deflation, but not that many of them. And usually, and you don't want the deflation. So I'd rather see the markets and see the economy continue to move upward. And I'd rather have that and try and fix things from that side of the ledger as opposed to trying to lower prices.
And you took the words right out of my mouth in terms of the next part of this is the lowering of prices. And again, you mentioned a geopolitical impact. And, that specifically the Israel, the Iran, the Ukraine, wherever things are happening. Yep. Here at home, with a certain amount of unrest and whatever's, which came or was born from the Israeli situation. But the question, there was one in there somewhere.
I believe you.
There was a question. It's bottom line. So geopolitical, all of those things, not so much the presidential election year, which we have also touched on multiple times. I heard this conversation this past weekend. And in fact, even yesterday, there was some talk about it. I heard on, probably a radio talk show or something, about the two candidates for president and who will bring prices down.
Yeah.
And that's not to say this candidate or that candidate. It was part of whatever the discussion was. But the idea of, and as soon as I heard it, the antenna shut up. I said, prices down? Mm-hmm. We know the inflation is whatever it is, and we may lower the inflation rate. But once that $10 cheeseburger happened, you're not going to see an $8 cheeseburger.
No.
It's $10 and increasing by whatever lower amount that it's increasing.
I mean, it's a supply and demand issue, right? All the way up and down the supply chain, if that's what you want, And who's going to lower prices? I mean, if the economy's still chugging along, the economy's not going to lower prices. So you're talking about some kind of government intervention to get prices lower? Okay, well, that's great, but if the government's taking money and doing something to try and lower prices, where's that money coming from? Well, theoretically, it's coming from the taxpayers. So all you're doing, in my opinion, is robbing Peter to pay Paul, right? So, I'm much more. I'm a big fan of the free market economy, right? Let the economy take care of things. Don't mess with things too. Now, there's exceptions, granted, but the more you can stay out of it, the better off you are, in my opinion. It'll adjust itself.
Well, the response, as we've discussed it before, in terms of prices coming down. The one place we do see it, interestingly enough, the one place that everybody complains about the most is the gas pumps. Sure. We see the prices go up, and we see the prices come back down. And so I guess maybe that's one of the key things. Maybe that is a specific thing that people are talking about. Who's going to get us back on track in terms of lower energy costs, maybe. But the typical conversation between you and I, your response when we talk about lower prices, something bad has to happen.
Generally, yeah. I mean, the economy has to start to slow down. Again, the definition of inflation is too many dollars chasing too few goods. Okay, so either you have more goods or you have less dollars right?
And that's the something bad has to happen
Yeah.
for the prices.
Yeah,
too,
so
right?
if all of a sudden there's less dollars, which means the consumer is now backing down, and something, they're concerned, they're losing their jobs, or there's a recession coming up, or something like that. That causes demand to drop, which means you have less dollars chasing, let's just say, the same amount of goods. So that can lower. But then then we talked about this a couple episodes ago. Was you can vote with your pocketbook too. Like if you finally make the decision that I'm not buying hamburger anymore because it costs too much, that you finally say, I've hit my limit, I'm not buying hamburger, I'm going to go buy chicken, right? Well, guess what? All of a sudden demand for hamburger drops, and maybe then you do start to get the price decreases and things like that. But it's, again, I'll say it one more time. I'm a big fan of the free market economy. Let things will work themselves out if you don't mess with them too much.
Right.
Yeah.
Well, it's Art Jarvis on Taking Stock, and Art Jarvis of Jarvis Global Investments. Sort of throwing a commercial, but there's a reason I'm bringing that up, and that is because in just the most recent couple of days, one of the topics for Jarvis Global Investments that you're sharing things out there with investors and potential investors is don't wait.
Yeah.
So let's talk a little bit about the investment world, and for people who maybe are sitting on money because we have this up and down market, and I don't know if they're sticking it on their mattress and waiting for the right day, but why should they wait, or why should they not wait?
Well, they most certainly should not wait. And you mentioned Caitlin Jarvis, who works with me, put a piece out yesterday, and it
that would be the daughter, not the wife.
That's correct.
Just for the record,
that to be the marketing / chief compliance officer of Jarvis Global Investments. But she put out a piece that basically illustrated the fact that the sooner you start investing, the better off you are. And she used the example of a person who started when they were, I think she said 30, and this person was putting $50 away or whatever the number was. But then compared to another person who waited 10 years until they were 40 and started putting, and they actually put twice as much money away periodically. Her point was, by the time they got to retirement, the person who was actually putting the lower number away, but started 10 years earlier, ended up, what was it?
Ahead of the person.
30-something% ahead of the other person that was doing that. So the problem with trying to time the market is, when I'm trying to decide what the market's doing, I'm trying to decide where the market's going to be 6 to 12 months from now.
Right.
Okay? So I have to get into a market when it still doesn't feel good to get into the market. And that's the problem with trying to time the market. It's like I'm getting out because the market, not me, but clients are getting, I'm getting out because the market's bad. Well, what's going to be the thing that gets you back into the market? Well, when things are better. Well, number one, what's your definition of better?
Costs you more.
Yeah, and number two, you got to get in before it's better, because by the time it's better, the market's already risen and you've missed. And we've talked about it before.
Right.
If you miss, I think the number is, if you miss like the top 14 best days in the market in the year, you've missed the vast majority of the returns in the market. So yeah. Now, if you're young, to me it's super easy. Whatever you can, start putting it away and be consistent about putting it away and leave it alone. Then you will be in great shape by the time you retire. The problem is I'm talking to a 20-year-old about something that's not going to happen for 45 years. Right. But if they would just put away $25 a week or something like that, they're in fantastic shape. So hopefully that answers your question. It's a simple equation. If you start early, you're in great shape. Because I think since 1957, and Caitlin used that period. That's when the S&P 500 was created. This is in 57. Since 1957 to today, the S&P 500 average annualized return is 10.26% per year. And that's in spite of all the stuff that's happened since 1957, right? A couple wars in there, .com bubble, 9/11, the Great Recession of 2008, the most recent, the pandemic. In spite of all those,
the historic timeline of my world from 1957 to today.
Right, there you go. Yeah.
To today. Yeah.
There's been some stuff that's happened in your lifetime, and in spite of that, we've still made over 10% per year on average.
That's a great place to call it a day for episode number 25. We think, Art, you and I, we both think that in 2 weeks from today, we're going to celebrate the 1-year anniversary of starting Taking Stock. So we'll have to do something special that day.
Yeah.
But I think what we did today was pretty special.
Yeah. No, again, number one, I'm very happy. We're starting to see a lot more views, so hopefully people are finding some value in this. I would love for people to ask some questions. If they ask some questions and we can actually answer or address certain concerns, that would be great.
Absolutely. Yeah. So when you see, on the internet or wherever you pick up the Taking Stock, episode 25 or any episode prior to this, you can comment. We put it out on the social media. You can comment. I have a question. You can reach out with a question to JarvisGlobalInvestments.com. It is .com, or is it?
That is correct. .com.
Which, by the way, I wanted to mention the website anyway. Go there and look at what Caitlin put together in terms of why you should not wait. Invest now. $10, $25, whatever you have. Like a savings account, like you probably were taught when you were a kid if you're already 20 or 30 or whatever. Get that first passbook savings account going.
Right.
And except let this be your investment account toward retirement. Right. But, there are places, to comment. There are websites and, lovelandbeacon.com. There are places for you to reach out there with a question. We would love to have your specific questions and address those. Art has been doing this for 35 plus years, and we will. And even if he doesn't know the answer, we'll endeavor to find the answer for you on Taking Stock.
Exactly right.
Art, thank you for joining us again today, sharing your insights. It seemed like we talked an awful lot about the economy.
Yeah. Well, I think that's what we're here for.
There you have it.
So, thank you very much. As always, it's a pleasure, and definitely enjoy it. Thank you.
Back in 2 weeks. Thanks for being with us today.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.